Look at these two companies, Tech Corp A and Tech Corp B. Both have $1 million in revenue and $100,000 in net profit. If you have to pick one company, the obvious choice would be Tech Corp B. Why would you not? Total assets in Tech Corp B is higher with the same profit. But here's the reality. Tech Corp B is days away from bankruptcy, while Tech Corp A is thriving. Stick with me, and by the end of the video, you will be able to see why it is so. This video is part 3 of the financial statement series, and understanding of balance sheet and income statement is necessary. So if you have not seen those videos, pause now to spend 20 minutes on the previous 2 videos and then come back. Today, we will be looking at the cash flow statement. Frankly, I can't emphasize enough on the importance of this document in analyzing companies. It literally rips the false narrative around problematic companies and makes it impossible to miss a good company. But before we start, you might ask, what is the need for a cash flow statement? Are balance sheets and income statements not enough? My answer would be that companies might be able to deceive people through profits on income statements, but they won't be able to hide the reality in cash flow statements. A company can be profitable on paper for years and still go bankrupt in a matter of weeks. Why? Because of the gap between earning money and actually receiving it. If you sell a product today but the customer pays you in 90 days, your income statement shows a profit, but your bank account is empty. You cannot pay your employees or your rent with paper profit. The cash flow statement is the brutal reality check that exposes when your profit is just an empty promise. Companies go bankrupt if they don't have cash to run their business and pay their lenders. Cash is the only truth that matters in business. One might ask where the distortion comes from, how income statements get distorted, and why do companies look profitable on paper while they starve for cash? It's because of the great divide between accrual accounting and the reality of your bank account. Let's see why the distortion happens. The non-cash buffer, depreciation/amortization. Companies spread the cost of massive equipment over years. It lowers profit on the income statement, but zero cash actually leaves the building during that time. The working capital trap, receivables and inventory. Companies often record sales to customers who haven't paid yet, or inventory that is becoming obsolete. These boost the assets on a balance sheet but represent cash that is stuck, not growing. The financing illusion, debt stock-based comp. Companies can use debt to fund operations or pay employees in stock instead of salary. These actions can artificially inflate the cash balance or reduce expenses to make a failing business look like it's just investing in the future. The timing mismatch, accounts payable. By aggressively delaying payments to suppliers, a company can keep its bank balance artificially high at the end of a quarter. It's a temporary mask that hides underlying cash shortages. Non-core asset swings. When a company records gains from selling off property, trading stocks, or moving money between investment vehicles, these one-time boosts inflate net income but have nothing to do with the actual product they sell. Next, we will understand the structure of cash flow and what are the sections in a typical cash flow statement. When we make a cash flow statement, we divide the cash flow in 3 pillars: operating activities, investing activities, and financing activities. 1. Operating activities, the heartbeat. This is the most critical section. It represents the cash generated from your primary day-to-day business operations, the actual reason the company exists. What it includes: cash received from customers, and cash paid out to suppliers, employees for rent, utilities, and taxes. What it tells you if your core business model is self-sustaining. The red flag. If a company shows a consistent net profit on the income statement but has a negative operating cash flow, it means the business is profit-rich but cash-poor. This often happens if the company is selling on credit, accounts receivable is too high, or has bloated inventory that isn't turning into sales. 2. Investing activities, the growth engine. This section tracks how a company is spending its cash on long-term assets to grow or maintain the business. What it includes: The purchase or sale of property, plant, and equipment, PPE, the acquisition of other companies, and purchases/sales of financial investments, stocks, bonds, or non-core assets. What it tells you, it shows the company's appetite for future growth. The red flag. A company that is constantly selling off its equipment or core assets to generate cash is likely in trouble. Conversely, while massive spending here is good for growth, if the company is investing heavily in non-core speculative assets, like crypto or unrelated market ventures, it indicates management is distracted from the primary business. 3. Financing activities, the funding source. This section shows how the company finances its operations. It represents the relationship between the company and its capital providers, banks and shareholders. What it includes: money received from issuing new stock or taking on bank loans, inflow, and money paid out to repay debt, buy back shares, or pay dividends, outflow. What it tells you: it reveals whether the company is growing through internal success or by relying on external debt. The red flag. If a company is constantly raising money through new loans or issuing new stock but has negative operating cash flow, it's a sign of a zombie company, one that is reliant on constant cash injections from outsiders just to keep the lights on. In the next section, we're going to walk through the cash flow statement line by line. As we do, you'll see exactly how we reverse these distortions to perform a full financial autopsy. Don't feel overwhelmed. This would all make sense when we are done with it. Cash flow from operating activities. We start with net income. That's the baseline accounting profit we pulled from the bottom of the income statement. But to find the truth, we need to make some forensic adjustments. First, let's talk about depreciation and amortization. On the income statement, we subtracted this as an expense to calculate profit. But remember, this is just a bookkeeping entry to spread out the cost of a machine over many years. No actual cash left your bank account this month. Since this entry made our profit look lower than our actual cash, we add it back to cancel out that artificial reduction. Next, we look at the increase in accounts receivable. This is the most dangerous line on the statement. It means we recorded a sale on our income statement, so our profit went up on paper, but the client hasn't actually paid us yet. Since that profit hasn't turned into real money in our pocket, we have to subtract it to see the actual cash available. Then we have the increase in inventory. If this number goes up, it means we spent cold, hard cash to buy raw materials or finished goods that are currently sitting on a shelf. The income statement doesn't see this as an expense yet, but our bank account definitely felt the hit. We subtract this because that cash left the business to fund that stock. Finally, consider the increase in accounts payable. This shows that we bought goods from suppliers but haven't paid them yet. Even though we recorded an expense on the income statement, our cash didn't actually leave the bank. We add this back because it represents cash that is staying in our business for a little bit longer. Investing activities, or what I like to call the growth engine. This section tracks how a company is spending its cash on long-term assets to maintain or expand its future. First, we have capital expenditures, or CapEx. We subtract this because it represents a heavy cash outflow, money spent on building factories, buying new technology, or upgrading machinery. A company that doesn't spend here might be milking its assets until they break, while one that spends aggressively is clearly betting on long-term growth. To calculate capital expenditures, or CapEx, we can't always just look at a single line on the cash flow statement. Sometimes we have to play detective and calculate it ourselves using two other financial documents. Here is the formula to do that. CapEx equals ending property, plant, and equipment, minus beginning property, plant, and equipment, plus depreciation expense. To get these numbers, you need to look at two places. First, check your balance sheet for 2 consecutive periods. Take the net property, plant, and equipment, or PP&E, value from the end of the year and subtract the value from the beginning of the year. This gives you the net change in your infrastructure. Second, grab the depreciation expense from your income statement. So why do we add depreciation back? It's because depreciation is a non-cash expense that reduces the value of your assets on the balance sheet every year. When you calculate the change in PP&E, that change is already artificially lowered by the depreciation you took. To find the actual amount of cash that left your bank account to buy new machinery or buildings, you have to add that depreciation amount back in to cancel out the accounting reduction. In short, the change in PP&E shows you the aftermath of your spending, and adding back depreciation reveals the total cash you actually invested. Next, we look at the sale of assets. We add this back because it represents a cash inflow from selling off old equipment or property. But be careful here. If this number is unusually high, you have to ask yourself, are they selling these assets because they are upgrading to better technology, or are they selling off their infrastructure just to keep the business alive? Now, how do we track the sale of assets? If the company doesn't list it directly in their cash flow statement, you use a simple forensic trick. Take the book value of the asset, which is what it was worth on your accounting books, and adjust it by the gain or loss you recorded on the income statement. If you sold an old machine for more than its book value, you had a gain, and that total cash is added to your investing inflow. If you sold it for less, that loss is subtracted. Finally, we have the purchase of investments. We subtract this because it tracks when a company uses its extra cash to buy stocks, bonds, or even crypto. When a business does this, it is essentially acting like an investment firm. We subtract this figure because that cash is leaving the core business to chase returns elsewhere, which can often be a distraction from their primary product. Finally, we come to the third pillar, financing activities. This section is all about the capital structure, the direct relationship between the business, its lenders, and its owners. First, we have proceeds from debt. We add this back because when we take a loan, cash enters our bank account. It makes the company look liquid, but remember, this isn't earned cash. It is borrowed money that comes with mandatory interest payments. If a company is constantly showing positive cash flow only because of new loans, it is a massive red flag. Next, we look at the repayment of debt. We subtract this because it represents a cash outflow as we pay down the principal on our loans. While this drains our current cash balance, it is actually a very healthy sign because it reduces our future interest burden and strengthens the balance sheet. Then there is issuing stock. We add this back because it represents cash that went straight into the bank when we sold shares to the public. However, this comes at a hidden cost. It dilutes ownership, meaning you are giving away a piece of your company to get that influx of cash. Finally, we have dividends paid. We subtract this because it is cash leaving the company to go to the shareholders. Only truly cash-rich, stable, and mature companies can afford to do this regularly. Seeing this on a statement is a clear sign that a business is done with its aggressive growth phase and is now generating enough excess cash to reward its owners. We started this video by asking why TechCorp B, with its $600,000 in assets, was on the brink of bankruptcy while TechCorp A was thriving. Now that you understand the cash flow statement, let's look at the actual forensic data for both. Look closely at the operating cash flow. TechCorp A is generating $150,000 in actual cash from its business. It's a self-sustaining engine. But look at TechCorp B. It shows a $100,000 profit, but it has a negative $50,000 operating cash flow. Where is the money? If we dig into their statement, we'd see their accounts receivable is ballooning, they are booking sales to customers who haven't paid them, and their inventory is stuck in a warehouse gathering dust. Now look at their financing line. They have a plus $100,000 inflow. That's not from sales. That's from a new bank loan they took just to pay the rent because their actual business is bleeding cash. The verdict: you don't pick TechCorp B because their assets are mostly unpaid bills and unsold stock, and their growth is being funded by dangerous debt. They look good on the balance sheet because they are hiding the rot in the footnotes. TechCorp A is the better company because it generates the cash it needs to fund its own future, rather than borrowing from a bank just to keep the lights on. If this series helped you demystify your financials, please like, subscribe, and share this with a fellow entrepreneur or investor. Let me know in the comments, which financial statement do you find the most confusing? See you in the next one.